Hello, finance friends. In this lecture, we're going to continue our thoughts on personal finance and move into something that for many of you might seem like it's a long way away, but is probably still on your mind and you know it's important. We're going to be talking today about retirement planning. So what we're going to do is we're going to start by taking just a really top level big picture view. I'm going to propose to you, and I have a summary of it here, a step-by-step process that you can follow in order to logically figure out your retirement goals, how much income you'll need to fill those goals, and then calculate the gaps that you're going to have, and then ultimately determine a monthly amount that you need to save starting now so that future you, decades from now, can have a great retirement. And then at the end, we'll talk a little bit about different types of retirement plans and the sources of income that you'll have in your retirement. Okay, so let's jump in and let's start by talking about the big picture. So really broad level thing. I would start off by saying that I think for most people, retirement is something that they plan to have and that they want to do. Very few people intend or want to work until they die. So I think it's safe to say that for most people, this idea of having a comfortable, and I'll even add in a meaningful retirement, meaningful meaning you're not just, sitting around watching reruns of Matlock, but instead, you're engaged in activities, you're maybe traveling, doing volunteer work, still fulfilling your goals. I would say that for most people, that idea is very appealing. And if that's the case for you, then you need to start thinking sooner rather than later about the retirement process. But fortunately, it's not overly complicated because much like other things that we've discussed in previous lectures, retirement planning is in fact a process. So there's simple steps that you can take. We're going to follow our one of our bigger metaphors of where do you want to go? Where are you now? And then craft the journey. Or seen slightly differently, how much money will you need in retirement? What do you have access to today? And then we go again to our old idea of filling the gap. So it's not overly complicated, but it is a process. So it requires a little bit of discipline, a little bit of knowledge. I do want to add a couple of things. Number one, retirement planning at the individual level is probably more important now than it's ever been before. And that's for a variety of factors. There's some social factors, you know, um, people are living longer, which is a great thing. There are medical advances that allow us to have higher qualities of life for many more years than people even a couple generations back could have ever imagined. All that's good. At the same time, that medical care has gotten very expensive. On top of general inflation, there's been really strong inflation in the health sector. In addition, there's been some corporate trends. And the primary corporate trend has been corporations moving, and I'll give you some jargon right now, which will make more sense in a few slides, but corporations moving from what are called DB plans to what are called DC plans. We'll get to it in more detail, but to put it quickly now, a DB plan, DB stands for defined benefit. And for a long time, at least here in America, DB plans were the norm. Under a DB plan, again, defined benefit, the companies that you worked for effectively made you promises of how much benefit they would pay you at retirement. DB plans, go by the common term pension plans. So under a traditional pension plan, you would work for an employer, you'd put in a certain number of years, and then as a reward for that service, your employer made a promise to you of the benefits that that employer would pay you in retirement. So the promise was made, we're going to give you this much money every month or every year in your retirement. That was really nice for the individual like you and me because we didn't have to do a whole lot of thinking. The burden of investment planning, of retirement thinking, all those things, the burden was with the employer. We had to work hard, put in our time, but that was our obligation. And in return, the promise was the employer would give us a set amount of money monthly or annually in retirement. What we moved to now, though, in America is really what's called a DC system. DC stands for defined contribution. And in a defined contribution, your employer no longer promises to give you a certain benefit in the future. They simply promise to give you today, when you're working, contributions towards your retirement plan. But that's all they promise. And with the DC plan, the burden has really fallen away from the firm, away from the company, away from the employer, and to us as the worker. So now with the DC plan, our employers, they promise that they will contribute. Again, DC stands for defined contribution. Our employer promises they will contribute money periodically to your retirement account on your behalf, but that's it. And the burden of thinking long-term, learning how to invest, watching over the portfolio, all of those things now fall with us as the individual. So you can see that the move from DB to DC plans has made retirement knowledge and the knowledge of these tools essential, because we can no longer, with a few exceptions, there's some occupations that still have pensions, but they're pretty much gone. And with most occupations today, it's up to you and I as individuals to handle and look out for our own retirement. What this means is, number one, you have to have a lot more knowledge now. And number two, you have to use the rules of time and start thinking about and acting on retirement early. And that's because ultimately you have a window of time between right now, when you're watching this, and when you want to retire sometime in the future. And time, as always, is your best ally if you use it correctly, or your worst enemy if you don't. Okay. And then finally, putting all that together, a lot of Americans still are not really appropriately preparing for their retirement. So what are some of the reasons? What are some of the pitfalls to good planning? Well, number one, just not thinking about your goals and not having an active way of thinking about the steps that you're going to take to make those goals happen. So that's one big pitfall. Another big pitfall, starting too late. If you wait until your 40s or 50s to start thinking about retirement, you've really lost a lot of valuable time. So don't start too late. And then, of course, the third pitfall, saving too little. We go back once again to the need to always be running net cash flow positive, to have that spare excess capital that you can deploy into investments. Okay. So that's that. The other thing with the approach that I'm going to teach you, retirement planning is by definition going to be a little bit difficult and a little bit uncertain, because we're talking about taking actions today that, depending on your age, may not come to fruition for 4 decades. Given all that time between actions you take now and plans you make now and the future as it's going to unfold, retirement planning really requires that you do a lot of estimating. You're going to have to make estimates of a lot of key economic variables that are going to impact your retirement. Those variables would include estimating the rate of return you'll earn on your assets, estimating the inflation rate you're going to face, estimating your taxes, and also, and this is a really difficult one, but estimating how long you'll live and the number of years that you'll be retired. And that's not something pleasant to think about, but you have to think, if you don't make that final estimate correct, let's say that you predict you're going to be alive for 20 years in retirement, but you live for 35 years, there's a definite chance you can outlive your money. And that's not a good thing. So you're going to have to be making estimates. One of the principles that we've learned, anytime that you're going to be making estimates, you want to always err on the side of conservatism. That means that you always want to underestimate flows of money into you, overestimate outflows. In the context of retirement planning, that's going to mean that you probably want to overestimate your annual expenses in retirement, overestimate how long you'll be alive in retirement, and overestimate the inflation rate. And then you probably want to underestimate the rate of return that you'll get on your assets. Okay, if you always err on the side of conservatism, it's going to be better for you. The last thing you want to do whenever you're making any long-term financial plans is overestimate, for example, your rate of return and underestimate the other variables. You can imagine the problems if you said, oh, I'm going to retire. I expect I'll get a 25% rate of return and inflation will only be 2% and I'll only have an 8% tax rate. That's being really generous with the money that you're growing and also really generous with the inflation and taxes that you're facing. And that's not a good approach. So you're going to always want to err toward conservatism by overestimating the things that will work against you and underestimating the things that work in your favor. Okay? So with that said, let's now move on and talk about the actual process. And I put together for you a summary sheet of this. You can see that we have here a very logical and linear step-by-step approach. This will be posted on the website so you have access to it. And then in a separate video, we'll put these steps together in order to take you through actual numbers, hypothetical numbers, and guide you through the process. So you can refer to this document. Again, it's on the website, but I'm going to take this and do it over here. So what are the steps? And I would offer to you that there's 5 steps to this process, but I'm going to add a 6th one in. Step number 1, so basically steps 1 through 5 are about the retirement part. And then this 6th step here takes us back into our investing lecture. Step number 1, as always, you need to be thinking about your goals. What kind of retirement do you want to live? When do you want to retire? Do you want to retire young? Do you want to retire old? Do you want to have the same sort of lifestyle in retirement that you have now? Do you want to spend a lot more money and have a greater, bigger lifestyle? Do you want to have a more toned down lifestyle? Are you going to give money to charities, money to family? Are you going to travel? All of those things are your retirement goals. We got to always start with the goals. And then of course, once we have those goals, we want to put some dollar terms on those goals. So step number 1 is just to have the courage to envision the best retirement that you can envision, and then put some honest, sensible numbers on those plans. Number 2, you're going to want to estimate the income that you'll have coming in during your retirement from either an employer pension plan, that's that DB plan. So if you work for a company that offers a defined benefit plan, a pension plan, you're going to want to estimate how much money that plan will be paying you when you retire years from now. And then second, you're going to want to estimate income from your Social Security sources. Okay, so again, the first step, get the goals in line and put some dollar values on those goals. That's how much money you're going to need. Step number 2, determine how much money you have coming in from either a pension and or Social Security. Once you know how much you're going to need, and once you know how much your pension and your Social Security will cover, step 3, you're determining the gap. The gap is the difference between what you're going to need and what you're going to get from company sources and government sources effectively. Once you know the gap, step 4, you're going to run some basic calculations using time value concepts that we already know, and you're going to determine what I call your Dow. There's lots of ways to call it. I just like this acronym. So I call it the DOW, your DOW, your day one wealth. And your day one wealth, that's the number, that's the size of the nest egg. That's the amount of wealth that you're going to need on the day that you retire in order to fill the gap that we identified in step 4. I'm sorry, in step 3. So step 3 was fill the gap. Step 4, figure out how much money you need in your nest egg on the day that you retire in order to fill that gap throughout the span of your retirement. Now, step 4 is where we do a little bit of math, and there's different approaches. So step 4 gets a little bit philosophical, and we'll cover that in a moment. Now, once you know your DOW, once you know how much money you need in your nest egg in order to make your goals a reality, you go to step 5. And you use your TVM concepts, your time value concepts, in order to estimate how much money you need to save monthly in order to hit your DOW. And then you start doing it, and you let the power of time work for you. And that's what it is. That's the 5 steps to the retirement part. There is a 6th step. Obviously, once you're saving money every month, you can't just leave it under a mattress. So you also have to make some decisions, the types of decisions that we hinted at in our investing lectures. Specifically, you need to figure out, once you're saving money, where will you invest that money? What asset classes will you use? Will you buy individual stocks, individual bonds, mutual funds, real estate? What asset classes will you invest your savings in? And then tied to that, what investment vehicles, what types of accounts will you use in order to carry and hold that money through the decades toward retirement? Okay, so those are the 5, and we'll say 6 steps to retirement planning. Really quickly, and again, we're going to do some examples together later on, but just to take you in a bit more detail, let's go through that. So in step 1, you're going to estimate your retirement expenses. Now, it's an estimate, so you're going to be making a prediction. And there's 2 general approaches to doing this. There's 2. Under the first approach, which is nice and simple, really easy, that's called the replacement rate method. And under the replacement rate method, you simply take a percentage of your current expenses, and that becomes what you estimate you'll need in retirement. So hypothetically, let's say that today your expenses are $100,000 a year. And let's just say that you randomly pick a replacement rate of 70%. Why would it be lower? Well, a lot of people advise that your replacement rate is less than 100% because they expect that in retirement, you'll have fewer expenses than you will when you're working and, paying off a mortgage, for example. Some people don't want to do that. They just make it 100%. But for now, let's just say you have $100,000 a year of expenses, and you expect a 70% replacement rate method. This means that you expect expenses, that you predict expenses of $70,000 in your first year of retirement. It's just a percentage of your current expenses. The second method is a lot more intricate. It's still good. That's the adjusted expense method. And in that one, you predict ahead all of the different expenses that you'll have in the future. You compare them to expenses you have now. So maybe you say, well, I'll have fewer mortgage expenses, but probably higher property tax expenses. And, if you have kids, since your kids will be done with college, let's say, you'll have fewer educational expenses, but maybe more healthcare expenses. So the adjusted expense method, it's a lot more intricate. It requires you to do a lot more thinking, but it could be more accurate. But either way, you're going to figure out how much you need using one of these 2 methods. Now, notice that this number, we'll use 70,000 for our example. This is not accounting for inflation, and it's not accounting for taxes. So that once you have the estimate, you then need to adjust that number to account for inflation. And then once you have that, you need to adjust it one more time to account for taxes. Now, this seems pretty tough, but it's not. You already know one formula. To adjust for inflation, we're just going to use one of our TVM formulas. The future value is equal to the present value times 1 plus the interest rate raised to the number of years ahead. So let's just say in our example, we were expecting $70,000. So we know that, I should have made a point, that's $70,000 in today's dollars. I should have said that earlier, so forgive me. So you're spending $100,000 in expenses today. You expect 70% replacement rate in the future. So you're saying that you're going to be spending $70,000 in today's dollars. But let's say that you don't plan to retire for 40 years. And let's say that you expect an inflation rate of 3%. Well, that means that clearly you're going to need a lot more than $70,000 every year, 40 years from now. So how do you adjust for inflation? Well, you simply find a future value. So in this case, the future value would be the 70,000, which is measured in today's dollars, multiplied by 1.03 raised to the 40. You calculate that number, and that gives you an inflation-adjusted number. And that tells you how much money you'll need in your first year of retirement. Another way to think about it, another way to think this through is, how much money will you need in 40 years? I think we lost that right there. Let me try this again. Sorry about the delay. We had a little internet problem. Let me try to get this going again. We're going to share our screen. And this will take us back to our page. Give me 1 second. Okay, there we are. Get rid of that. All right. So again, the question here, and I apologize for the internet delay. The question here is, how much money will you need 40 years from now, given an inflation rate of 3%, to have the same purchasing power as $70,000 today? Okay, you run that number, you're going to get a big answer, which corresponds to something that most of us know intuitively, and that is that inflation is a bitch, because $70,000 today is not going to have anywhere near I should say this, what you can buy for $70,000 today will cost you a lot more money in 40 years. $70,000 over 40 years will rapidly lose its purchasing power because of the crime of inflation. So that's one formula that adjusts for inflation. And the second one, to adjust for taxes, we're going to use this. Pre-tax income is equal to after-tax income divided by 1 minus T, where T is your expected average tax rate. If you have an investment account and your distributions are taxed in the future, then you also need to account not just for the power of inflation, but for the power of taxation. So we're going to take the number, step 1. Step 2, we're going to apply the future value formula to adjust for inflation. And then step 3, we're going to apply this formula to adjust for taxation. By the end of this, you will have a pre-tax, inflation-adjusted number that you will need in 40 years in order to have $70,000 of comparable purchasing power in today's terms. So that's step 1. Sounds like a lot, but it's really not bad. Now, step 2. In step 1, you figured out how much you need. In step 2, we start analyzing the sources of that. And for most of us, we're going to have three primary sources of retirement income. The first one will be any pension plans, what we called earlier defined benefit plans that your employers, either current employers or previous employers, offer. And then the second benefit will be government benefit if you qualify and are entitled to receive Social Security. So if you have that, now you know a part of your income. Now, once you know up here how much you need, and here you have a few sources, now we can go to step 3 and we can determine the shortfall. In other words, here we're looking for the gap. And the formula here is pretty straightforward. It looks like this. Your pre-tax inflation-adjusted income in year 1 of your retirement, again, that's what we calculated above, minus any expected defined benefit income minus any expected Social Security income. Oops, there we go. Will equal your retirement income shortfall. In other words, your gap in year 1 of retirement. So now we know how much money you're going to need in year 1 of retirement, and that's your income shortfall. Now, that income shortfall that you estimate in year 1 is then going to be applied using TVM tools so that over the course of not just your first year of retirement, but all the subsequent years, you're going to be able to bridge that gap. And that takes us to step 4. Calculate your Dow number. Many people have many different names for this. I call this your day 1 wealth number, your Dow number. And this is the amount of wealth, or seen differently, the size of your retirement nest egg that you're going to need on the day that you retire. That's why I call it your day 1 wealth, the wealth that you need on day 1 of your retirement. This is the amount of wealth or the size of your nest egg that you need on the day that you retire in order to generate the income shortfall we just calculated. In other words, your Dow generates the funds that you need to bridge the gap from up here. Now, it gets a little bit more complicated here because there's a couple of different ways that you can approach this. In general, number 1, you can take what's called the capitalization or interest approach. What this does with the capitalization or interest approach, you basically have this day 1 nest egg, and all you're doing is living off the interest. So you have a nest egg that's big enough so that the interest that it generates bridges this gap here. Now, if you can achieve that, that is fantastic, because if you can live entirely off interest, you will never have to tap into your principal. And that means that it is impossible to outlive your money. And it means that you can leave all of your principal to your beneficiaries, helping establish some of their financial success. So this is great. But it is going to require a pretty big number. The second approach that you can take is what we would call the annuitization approach or the drawdown method. Now, with this approach, you structure your nest egg like an annuity, where every year you take a little bit of the principal and a little bit of the interest that the principal generates. The following year, you'll take a little bit more principal and a little bit of the interest that the remaining principal generated, and on and on and on. Okay, it's called the drawdown approach because over the course of your retirement, you're going to draw down on your principal. And you're basically going to be you're going to be spending your retirement living on a combination of, number one, the principal that you withdraw, and number two, the interest that your remaining principal generated. Now, the advantage of number two, the advantage of this approach is you do not need nearly as big of a nest egg because you're going to be drawing down your nest egg. The disadvantage of number two, though, is it's possible to outlive your money. And if and when, if you decided that you wanted to leave something to beneficiaries or to your heirs or to your family or to a charity, there's no guarantee there's anything left because ultimately, again, you're drawing down on your principal. So you have to decide based on your goals, which of these two approaches you're going to use. You also have to make another decision. When I did the capitalization approach, I had said that you can live off the interest and you can generate a stream of money, which is great. But remember, inflation is a bitch. Okay, inflation is theft. And we have to think, another decision we have to make, are you going to want a constant stream of income, meaning you get the same amount of income stream every year that you're retired, or are you going to want an income stream that is accounting for inflation? In other words, do you want a flat income stream, or do you want an income stream that goes up every year in line with inflation? Obviously, if you take the constant income stream, over time, you're going to see your purchasing power fall. Because again, inflation erodes the value of your dollars. If there's inflation occurring while your income stays flat, the real result is your buying power falls. If you want to keep your purchasing power constant, then you need to have your income stream adjusted for inflation, which means you're going to need to see your income stream go up every year. Okay? So that's how that works. There are a couple of other formulas here as well. So let's go through those. The first formula is this. So let's do formula number one. Your Dow number, if you want a constant stream of income and you want to go under the interest-only approach, okay? We called that up here the capitalization approach, the interest-only approach. So if you want to have a constant stream of income and it's interest-only, then your Dow number is the income that you need divided by R, where R is your rate of return. What this means is if you divide the income that you need by R, that big number that you get, when multiplied by the rate of return, tells you your income. So you live off the interest. So that's one approach. The second approach, or the second formula, is, again, what's the Dow that you need? But this time, if you want an inflation-adjusted stream of income. So now we don't want a constant stream of income. We want our stream of income to go up every year to account for inflation. So you want an inflation-adjusted stream of income. Sorry about that. Let's get this cleaned up. An inflation-adjusted stream of income. But again, we want to do this on the capitalization approach and live on interest only, preserving that capital. In this case, your Dow number is going to be equal to your first year income requirement divided by R minus I. R is still your rate of return. I is your rate of inflation. So you can see that with this approach, we're now accounting for inflation. The net of this is that your denominator is going to be a smaller number, so you're going to need a bigger Dow to live on the interest. So those are two formulas. Take a moment and get those down. And then we have a third formula. And that third formula, let me make some space here. So those two formulas were, again, the capitalization approach, living on interest. The third formula would be if you want to use the drawdown approach. In other words, you're going to draw down your principal and live off of a combination of the principal and the interest. So let's do a drawdown approach, and we're going to make this inflation adjusted because we always want to account for inflation. Okay, just so you know, this is known as an inflation adjusted annuity. This is known as an inflation adjusted annuity. And if you opt for this, then your Dow number is going to be, I'm going to actually put it down here because I need more space. Your Dow number, your day one wealth number, is going to be your first year income divided by R minus I, just as before, but now we're going to multiply it by a factor, and that is going to be multiplied by 1 minus 1 plus I divided by 1 plus R raised to the N. And in this case, N is your expected number of years in retirement. Obviously, you don't want to underestimate that one, or you might outlive your money, and that's not a good thing. But this formula here, if you're going to use the drawdown approach, tells you how much money do you need in your nest egg on the day that you retire to generate an inflation-adjusted annuity for a particular number of years of retirement. Now, in my opinion, for most people, this is the most practical, useful, and accessible. It's also going to be a lower number, oops, I erased it, than the first one. But all things considered, if you can generate a situation where you can live off your principal, it's going to be way better. But again, it's going to take a lot more investment, a lot more nest egg. So that's our fourth step. And then our fifth step is, again, once we know how much money we need here, we once again fill the gap. So we've determined in step 4 how much money we need in our nest egg in order to retire under one of the different arrangements that we've seen. Now we translate that using time value tools into a monthly savings target. Now, there is one little complexity here. If you currently have savings or investments, so if you've already got some money in the bank, some money in an IRA, some money in a brokerage account, since that money will also be a source of your future income, the first step you have to take is to find the future value of those funds. Once you have the future value of those funds, then you subtract that from your Dow number. Meaning this, let's say that you calculate, we'll just make up a number here, that your Dow number is 1,700,000. In other words, you determine I need $1,700,000 in my nest egg on the day that I retire in order to fill the gap and meet my goals. Beautiful. Now let's say that you currently have some money in a 401k or other investment account. You're going to calculate how much money that'll be worth when you retire. Let's say that it'll be worth $900,000. Well, you're going to subtract that 900,000 because the Dow was how much you need after Social Security and pensions. You also subtract your own savings, and this would then leave you with 8,000. And that 800,000. And that 800,000 is sort of like a modified Dow, a modified day one wealth number. And that's the number that you need to earn. From there, you use TVM concepts, solving for payment, and you're going to be fine. Okay? So there's a lot going on. It sounds like a lot, but trust me, we'll do in a separate video. We'll take it step by step into a practice problem, and you'll see it really flows together easily, and there's nothing new. It's the logic that you already know about setting the goal, finding where you are, and bridging the distance, right? About figuring out how much you need, how much you have, and bridging the gap, and then using TVM skills to do it. So we know that, and we'll go through it in a separate video. Now, there is one extra step. Step number 6, once you determine how much you need to save every month, remember, you're not going to get wealthy by putting that savings under your pillow. You're going to need to determine, A, where you will invest it, and B, using what kind of vehicle. In other words, you cannot just let your retirement contributions sit in cash format. You have to actually buy actual investment assets. You need to invest in asset classes, maybe stocks, maybe bonds, maybe real estate. You know me, my preference, passively managed, no load, low fee index funds, as we've discussed before, but that's up to you. And then once you know what you're going to buy, you have to also think about the type of accounts that you're going to put it in. Remember the golden rule when it comes to investing. You invest in asset classes and invest through the vehicles. In other words, the vehicles, and those vehicles can include IRA plans or 401k, 403b. There's a lot of different types of vehicles, but the vehicles hold the assets and carry those assets through time, often with tax benefits. So that's the 6-step thing. Sounds like a lot, but in a separate video, we'll make it real tight and you'll see how it flows together. And here's the beauty. It might take you, the first time you do it, 20, 30 minutes to solve a problem. But think about what that means. You put a half hour in with some good, reasonable assumptions, and right here, right now, you can set a plan in action that will make future you, when you're old and gray and bitter and gravity has taken its toll on you, but you can still achieve your goals. You know, it's not hard. Anybody can do it. You just have to have some thinking and know some tools, and I'll show them to you. Okay. Final part of today, we know the big picture of planning, and we've got this 6-step method for getting the right numbers in place. I want to talk about the sources of retirement income. And I've hinted at this earlier in the video, but ultimately, I want you to imagine your retirement income as a big stream, this like roaring river. And like any river, your retirement income river should be fed by multiple smaller streams. Think about what this means. If you have a river and it's only fed by one stream and that stream dries up, your river dries up and you're going to have issues. So instead, in the name of diversification, you want to have a big river of money, a big river of income, and have that river fed by as many different streams as possible. The big 3 streams, though, will be these: Social Security benefits, employer-sponsored retirement plans. This can either be DB or DC, and then, of course, your personal savings. You want to do whatever you can so that all 3 of those streams become as big as possible, thereby giving you a robust, huge, roaring river of retirement money, such that if any one of those streams were to dry up, you're still going to be okay. Okay. So let's go into them. The first of the streams is Social Security. This is basically what's known as a pay-go plan. It's a pay-as-you-go plan. It's operated by the federal government. And as we learn in the tax lecture, Social Security is funded by your FICA contributions. We know that on your pay stubs, you're going to pay Social Security taxes and you're going to pay Medicare taxes. Those two together, Social Security taxes and Medicare taxes, that's your FICA. It's also called your OASDI. Got a lot of names, but this is Social Security. And it's going to be one of your streams if you qualify. How do you qualify? Well, the rules basically say that you will be eligible for SS benefits provided, number one, you earn a minimum amount of income. In 2024, that was $1,730, and that you earn that minimum income over the course of 40 quarters. 40 quarters is basically 10 years. But it's quarters intentionally because it does not have to be consecutive. If during your working life, you work for an accumulated total of 40 quarters or more, and you earn at least $1,730 per quarter, you are eligible under current rules for Social Security. Now, it's easy. There's a lot of calculators, but they're a pain. The easiest way, you should just go to this website, www.ssa.gov. That's the website for the Social Security Administration. And once you log on to that site, go to My Account. Once you're there, you set up your own account that's tied to your Social Security number, put a good password on it, and then you'll have access to your actual benefits. In fact, once a year, you'll be able to download your Social Security statement. And that statement will tell you, among other things, how much money you've contributed, which is fine, but critically for your planning, it will tell you if you were to retire on a normal timeline, what's your estimated benefit. So they give you the tools right there to make an estimate of one of your streams of income. Good stuff. Your second potential source of income is income from retirement plans that your bosses, that your employers put together, okay? As a quick aside, lots of employers now set up retirement plans for their workers. Now, you might be asking, why would a boss do that? Well, in large part, it's because they want to offer this as a benefit so that it makes the job look much better. In other words, it's not just your salary that you work for anymore. You work for your salary and your health benefits and your retirement plan benefits. So good companies will typically offer you lots of different ways to gain, including your salary, but also a retirement plan, okay? Those plans, as we said before, can either be DB or DC. And once again, just to reiterate it, under a defined benefit plan, which is also called a pension plan, your employer, okay, that company, they basically make you a promise as to the specific benefit that they're going to give you when you retire. Under a defined contribution plan, you don't have that benefit promise. Instead, in these, as a worker, you will have access to a retirement account that is sponsored by your boss. You can contribute money into that account, and oftentimes your boss will also contribute. With this kind of plan, a DC plan, your employer makes a promise as to how much they'll contribute on your behalf. This is oftentimes known as the match. If you put in a particular amount, your employer will match you with a particular amount, but that's their only promise. Critically, your employer makes no promise about the benefits that might result, and they give you no advice on how to invest it. In other words, with a DC plan, The entire burden's on you and on me. And that's why these tools are so important to learn about. So those are your two types of plans. When it comes to DC plans, there's a couple of different types. They all function the same, but they have different names based on if you work for a for-profit, a nonprofit, or a different type of firm. So you might hear them called 401k plans. You might hear them called 403b, or even 457 plans. When you hear 401k or 403b or 457, you should know that all of those simply refer to types of employer-sponsored DC plans, and they all behave the same way. Critically, here's how they behave. Number one, the contributions that you put into those are made with pre-tax dollars. This is very important. This means that the money that you contribute to these plans is effectively shielded from taxes. Again, your contributions are made with pre-tax dollars. This reduces your taxable income and reduces your taxes, effectively amounting to an upfront tax benefit. So let's say, for example, that you have a job where you make $60,000 a year, that's your gross salary, but you decide to contribute $15,000 a year. Since you're putting $15,000 a year in, the amount that's left over is $45,000. And that becomes the basis of your taxable income. So you're magically and legally shielding $15,000 from different taxes. That's not a bad thing. Number two, second provision of these plans, all the money that you earn in those plans, so the earnings that you make, whether it's interest earnings or dividend earnings or capital gains, all of the earnings that you make, as long as the assets are held in this particular DC type of bucket, in this particular vehicle, they grow tax-free. Now, this may not seem major to you, but believe me, it's major. And it's major because if your money is growing tax-free, that means that no money is taken out of your account for taxes. And if no money is taken out of your account for taxes, then the money that's in there is fully compounding. And that compound interest, as you know, is the key to your long-term wealth. So these are two great things. The money you put in, you're getting an immediate tax break. As the money grows, it grows tax-free. Ultimately, you only are taxed when you pull the money out in retirement. And that's the third provision. The withdrawals that you make once you're retired in the future, your withdrawals are simply treated as taxable income, as ordinary income, and are taxed as such. We had said in our tax lecture that there's really three goals when it comes to tax planning: eliminate, defer, or reduce your taxes. You can see that DC plans, with all their different things they do, they allow you to eliminate some taxes while you're in the plan, and all of this has the impact of deferring taxes. And you can imagine if you're in your 20s or 30s now and you're going to retire in 30 or 40 years, how great it is for your wealth if you can defer taxes for 3 or 4 decades. Because every dollar that doesn't go to the government in taxes is all that stays in your account, compounding and growing for you. So that's the employer-sponsored plans. And then the third type are the plans or the options that you have for your own money. And you have several options on how to invest and use your own savings, your own money. The most important of those options are your IRAs. And an IRA is an individual retirement account. This is an account that you set up, you fund it on your terms, and you put money into it based on your cash flow to invest. And in theory, your IRA becomes yet another stream along with your Social Security benefits and your 401k, and now your IRA. This is your own personal savings. Now, IRAs have two types: the traditional IRA and the Roth IRA. And here's the main difference. The traditional IRA is also called the deductible IRA. And it's called that because with a traditional IRA, the money that you contribute, you can claim as a tax deduction. So the contributions that you make are potentially tax deductible, which provides you with an upfront benefit. That's good. These earnings will grow tax-free as long as they're in that IRA bucket. And your withdrawals will be taxed as ordinary income. So you can see that the traditional IRA, it behaves in a way that is very similar to a 401k or 403b plan. Upfront tax break, grows tax-free, so it's tax deferred. And then when you finally pull the money out in retirement, it's taxed as income. Beautiful. But even more beautiful, if you can swing it, is the Roth IRA. And this should be part of your retirement strategy. A Roth IRA is still an IRA, but notice the difference. With a Roth IRA, the money that you contribute is not tax deductible. So you're putting money into your Roth IRA that you've already paid taxes on. It comes from your after-tax income. There's no tax deduction, so your Roth contributions have already been taxed. And because they've already been taxed, get this. When you finally pull that money out, you pay no taxes on it. Generally, you have to pay the IRS once. So think about it. With a traditional IRA, you're paying taxes, you're getting a tax break up front, so you're paying taxes when you take it out. But look at a Roth IRA. You're paying the taxes up front because you get no tax break. And as a result, the earnings will grow tax-free, but critically, when the time comes for your retirement and you make a legitimate qualified distribution or withdraw, that withdrawal has no tax. I want you to imagine what it would be like if at the time of your retirement you had $750,000, maybe $1 million in a Roth IRA. That means that you can retire knowing that you've got $750,000, maybe $1 million in an account where all the taxes have been already taken care of, and every withdrawal that you make is tax-free. The government doesn't touch it. It's all yours. And that's a good thing. Okay. In addition to the IRAs, which is what you really need to focus on, there are a few other options. You can have money in a traditional brokerage account without the IRA benefits, but you can still have that. If you're self-employed, there's a few plans like a SEP IRA for self-employed people. There's a role for a tool called a retirement annuity. A retirement annuity basically is when you retire, you can think of a retirement annuity as a contract between you and an insurance company, basically. And the way that it works is at the time that you retire, or maybe before, you give the insurance company a big lump sum of cash, and in exchange, they pay you a series of payments for a specified period of time. You can think of a retirement annuity as yet another stream that can contribute to your big roaring river of retirement wealth. And then there's also home equity loans. So if you have a home and it's paid off, you can draw some income or at least some cash from that. And there's another tool tied to your home called a reverse mortgage, which allows you to use your home as collateral for a loan, typically with a mortgage company, and they will give you a stream of money or a lump sum, which you don't have to pay back until either you move or more commonly you die. So anyway, these are the options for individual retirement savings But again, in context, the individual savings are one of the three primary forms of your retirement river of money. Okay. I've talked about the annuities, but really quick, it's a contract between you and an insurance company. You contribute funds to the annuity, and then when it's called annuitization. At that moment, when you convert it, the company pays you a stream of payments for a specified time. So that's another tool you can have. And with that, my friends, that's all we have. So to recap, in this lecture, we learned about the basics of retirement planning. We learned a 5, maybe we'll call it a 6-step process for how to get from a goal to an actionable number. And then we learned about some of the vehicles that you can use. You can use Social Security benefits, defined benefit pensions, defined contribution plans, IRA plans, and annuities to generate multiple streams of income to help you have a great retirement and a roaring river of money, and also put you in a spot where you're protected. Because again, if you have a river with only one stream in it and that stream dries up, no more water for you. So you want to diversify your streams of income, so if any of them suffer, you're still going to be okay. Thanks for your time, and tune in for a follow-up video where we will take a actual set of numbers, follow our process, and you can learn how to do it, and then from there be able to take the action and set up your own retirement plan. Thanks for your time. Take care.